So, you've worked hard for your money. You've saved up, maybe skipped a few of those expensive coffees, and now you have a nice little pile of cash ready to invest. That's awesome. The big question now is, what do you do with it? The most important rule in investing is something your grandma probably told you. Don't put all your eggs in one basket. This simple idea is what we call diversification. It is the single most effective strategy to protect your hard-earned money while helping it grow over the long term. It sounds complicated, but it's really not. It's just about being smart and not betting your entire future on one single thing. Let's break it down. Diversification simply means spreading your money across many different investments. Instead of buying stock in just one company, you buy stock in several different companies. And you don't just stop there. You can also buy other things like bonds, real estate, or even index funds, which are like big baskets of stocks all bundled together. Think of it like a pizza. A pizza with only one topping might be good, but if you don't like that topping, the whole pizza is ruined. A supreme pizza with lots of different toppings is much more likely to have something you enjoy, even if you have to pick off the olives. Here's a simple example to make it crystal clear. Imagine you have $1,000 to invest. You could put all of that money into one single company that makes, let's say, umbrellas. If that company does really well because it rains all year, you could make a lot of money. But what if there's a huge drought and nobody buys umbrellas? Your investment could lose a lot of its value, maybe even all of it. That's a huge risk to take with your savings. You are essentially gambling on the weather, and that is not a solid financial plan for your future. Now let's see what happens if you diversify. Instead of putting all $1,000 into the umbrella company, you put $100 into it. Then you put another $100 into a company that sells ice cream. You put another $100 into a big tech company, $100 into a bank, and so on, until your whole $1,000 is spread out across 10 different companies in 10 different industries. Now, if the umbrella company has a bad year because of sunny weather, the ice cream company might have a great year for the exact same reason. The losses from one investment can be balanced out by the gains from another. The main reason to diversify is to protect your money from big losses. This is all about managing risk. Every single investment has some level of risk. A company could go out of business. A whole industry could face new, tough regulations. The entire stock market could go down for a while. You can't get rid of risk completely, that's just part of investing. But you can manage it so that one bad event doesn't wipe out your entire portfolio. By spreading your money around, you make sure that the failure of a single investment is just a small bump in the road, not a devastating crash that sends you back to square one. Let's compare two investors to see how this works in the real world. Investor A is very confident. He puts his entire life savings of $100,000 into one exciting tech startup that everyone is talking about. For a while, the stock does amazingly well. Investor B also has $100,000, but she diversifies. She puts her money into a mix of hundreds of different stocks through a low-cost index fund, and she also buys some government bonds, which are generally very safe. She is not chasing a huge, fast profit. She's building her wealth slowly and steadily over a very long time. Suddenly, the exciting tech startup that Investor A invested in has a major problem. A competitor releases a better product and the company's sales plummet. The stock price crashes and Investor A loses almost all of his $100,000. He is completely devastated. Meanwhile, Investor B's portfolio barely notices, because the failing tech company was just one tiny piece of her overall investments. The loss is very small. In fact, some of her other investments likely went up in value during the same period, offsetting the loss. While Investor A is back to saving from scratch, Investor B is still on track for her financial goals. This story shows the true power of diversification. It's not always about getting the highest possible returns in a short amount of time. It's about getting good, steady returns over many years while protecting yourself from catastrophic losses. The famous investor Warren Buffett has two rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Diversification is the best tool you have to follow that advice. It helps you stay in the game long enough for the power of compound interest to work its magic on your money, which is how real, lasting wealth is built. So, how does a beginner actually start diversifying? It might sound like a lot of work to buy hundreds of different things, but it's actually easier than ever before. The best place for most people to start is with low-cost index funds or exchange-traded funds, also known as ETFs. These are incredible tools. When you buy a share of an S&P 500 index fund, for example, you are instantly buying a tiny piece of the 500 largest companies in the United States. With just one single purchase, you become an owner of Apple, Microsoft, Amazon, and 497 other companies. That is instant diversification. But you don't have to stop with just US stocks. You can diversify even more. You can buy an international index fund to invest in thousands of companies all over the world. This protects you in case the US market has a slow decade while other countries are growing quickly. You can also diversify across different types of assets. This means owning more than just stocks. You can add bonds to your portfolio. Bonds are basically loans you make to a government or a company, and they are generally considered much safer than stocks. They might not grow as fast, but they provide stability when the stock market gets rocky. Another way to diversify is by investing in real estate. This could mean buying a rental property, which can provide a steady cash flow every month. If that sounds like too much work and requires too much money up front, you can invest in a real estate investment trust, or REIT. A REIT is a company that owns and operates properties like apartment buildings, shopping malls, or office towers. Buying a share in a REIT is like buying a stock, and it lets you invest in real estate without having to be a landlord. It's another great way to add a different kind of asset to your mix. The key is to not just buy different things, but to buy things that behave differently from each other. Remember the umbrella and ice cream companies? One does well in the rain, the other does well in the sun. That's what you want in your portfolio. You want some investments that zig while others zag. This combination of different asset classes, stocks, bonds, real estate, and different markets, US international, is what creates a truly resilient and robust portfolio that can handle whatever the economy throws at it. And the best part is, you can do all of this with just a few different index funds or ETFs. In the end, diversification is not just a strategy, it's a mindset. It's about being humble and admitting that you cannot predict the future. No one knows which company will be the next big thing or which industry will face unexpected trouble. By diversifying, you are acknowledging this uncertainty and building a financial plan that doesn't depend on you being a perfect fortune teller. You are building a solid fortress for your money, one that is designed to withstand storms and stand the test of time. It's the responsible, smart, and proven way to build long-term wealth without taking unnecessary risks. Think of it this way: building wealth is a marathon, not a sprint. People who try to get rich quick by betting everything on one or two hot stocks are sprinting. They might get a quick lead, but they are also very likely to stumble and fall, getting seriously hurt along the way. The diversified investor is running a steady pace. They might not be in the lead during the first mile, but they are conserving their energy, avoiding obstacles, and positioning themselves to finish the race strong. Slow and steady really does win the race when it comes to your financial future and achieving your goals. My advice is simple: make diversification the foundation of your entire investment philosophy. Don't get tempted by the stories of people who made $1 million overnight on a risky bet. For every one of those stories, there are thousands of untold stories of people who lost everything trying to do the same thing. You don't need to hit a home run with every investment. You just need to consistently get on base. Over time, those small, consistent gains will compound and grow into a significant amount of money, far more than you might imagine. So, as you continue on your investing journey, always remember the simple wisdom of not putting all your eggs in one basket. Spread your investments far and wide. Use low-cost index funds to make it easy. Stay consistent, stay patient, and let the power of diversification protect and grow your money. It is the single most important thing you can do to ensure your financial success and give yourself peace of mind. Your future self will thank you for it, and you will have built a financial fortress that will serve you for the rest of your life.